Hi there, welcome to my channel. Please do me a favor, like, share, and subscribe to my channel. I really would appreciate it. And hit that notification bell so that you're notified about my upcoming video. Thank you so much. Well, here's my portfolio. Here's an update on my portfolio. This is my dividend tracker. And so mostly I use this to see just how much I'm going to be making on a monthly basis in dividends. So as you guys can see here, we should be making about $5,700 on a monthly basis in dividends. And as you can see, there's the annualized estimate of that monthly income. And this is the performance here on my dividend tracker. And but let's go over to my actual Robinhood portfolio. I did hear that I guess sometime soon, Robinhood will actually have a dividend tracker in their app, which I'm looking forward to that because if that does happen, and they said it will, I guess maybe next year, I won't have to use this dividend tracker anymore. And this dividend tracker isn't free. I am paying for it on an annual basis. I think it's like $40 a year, so it's not that bad. It's a fairly good dividend tracker, but I would prefer for it to be straight on the Robinhood app. So let's open this up. So as you guys can see, here's my portfolio. In the after hours, we're up 0.16%. And so if we go over to this other screen here, during the day, in the morning, as you guys can see, the market was up, but then as soon as the market opened, it just started to trend down. And one of the reasons that I think it started to trend down is because people didn't really know if there was going to be a rate cut or not. And so there was still a certain amount of uncertainty whether there would be a rate cut or not, although the chance of a rate cut was above 90%. And so there was a rate cut, which is good. And so for the most part, my portfolio was going down practically all day until about 11 o'clock, right about here, when it was confirmed that there would be a rate cut. So as you guys can see here, as soon as there was a confirmation that there was a rate cut of 0.25% or 25 basis points, the market just spiked. But soon after it spiked, it also went down and then spiked up again and then went down again and finished off the day, as you guys can see, in the green. But last night, the night before the rate cuts, I was somewhat concerned because I didn't know what way the market was going to go. Lots of people were saying that the market was going to go up on rate cuts, and that the market had already been going up in anticipation of the rate cuts. So basically, it was the rate cut possibility had already caused the market to rise. And so that's why for these past few days, I guess about a week or a little bit over a week, the market has been had been rising. And then we finally did get the rate cut, and the market seemed to pump and then kind of sell off. And so before all this happened, I was thinking about, well, what's going to happen and how can I protect my portfolio? What can I do in case they say, sorry, no rate cuts, right? Because if they would have said, sorry, no rate cuts, that would have been really bad. I think that there would have been a fairly large crash, probably, or a crash, if there would have been no rate cuts. But since there was a rate cut, that's not bad news. It's good news. And so, I guess I expect the market to continue to rally, I guess, moving forward. But I was fairly concerned about, well, what if they don't cut rates? Because if they don't do it, then the market's going to go down. And so every month I buy puts. So one way to protect your portfolio is by buying puts. So let me show you guys an example here of a put, and I kind of overdid it this month. I bought more puts than I have ever bought at any other time because I was concerned about it. I was even thinking of selling a little bit of my portfolio to have a little bit of cash in case there was a downturn in the market, but decided to just buy more puts. And so let me show you guys how this works out. Let's look at this put at the very bottom, a put on the S&P 500 or SPY. Let's open this up. As you guys can see here, this put currently is in the red. The reason it's in the red is because the market did end up going up. And so when the market goes up, the value of these puts goes down. If the opposite happens, right, if the market goes down, then the value of these puts goes up. And so let me show you guys just how much this put cost me. It cost me $1.48. So it's times 100. So it's actually costing me $148. That's what this put cost me. Currently, I'm losing about $10 on this put. But it's okay, I don't mind losing money on this put. And I'll show you guys why I don't mind losing money on a put. If we look here, Robinhood has this simulate my returns, right? It can simulate the return of a put. So if we go here, I'm currently losing $19 on this put, but the maximum amount I can lose is $148. So on this put, I can only lose $148. So if the market continues to go up in this direction, I continue to lose on this put. As you guys can see, the put becomes less and less valuable. But the maximum amount that I can lose on this put, like I said, is $148. Now, what happens if the market takes a dive? Well, we just go in the opposite direction here. As you guys can see, let me speed that up here. And we're at 2%, 3%, 5%, 7%, 8%, 9%. This would be a little bit over 10%. So if the market were to crash just about a little bit over 10%, which would just be a correction, this put, as you guys can see, would be worth $1,211. So it would be more valuable than what I bought it for, because I bought it for $148. So a 10% drawdown in the market in the S&P 500 would cause this put to be increased in value to over $1,200. Now let's say it crashes by another 10%, which would be a 20% crash. So let's go down all the way to 20. And we're almost getting there. 17, 18, 19, 20. So as you guys can see, at a 20% crash, this put would be worth over $5,300. All right. If the market were to draw down by 20%, then this put would become more valuable. Now, let's say that there was, an extreme crash or a larger crash. Let's go to 30. We're almost there. 25, 26, 27, 28, 29, 30. So at a 30% crash, right? This put would be worth close to $12,000. So if the market were to crash by 30%, this put would be worth close to $12,000. So is it worth it, right, to pay $148 for the possibility of making, $12,000 if the market crashes? I think it is worth it, because if the market continues to go up, well, then that's great, because that's what I really want. I want the market to continue to go up in value. And if that happens, well, that's great. All that I can lose on this put is $148. So I don't mind losing $148 for the potential possibility that if the market crashes by any of these percentages, right, by 10%, 20%, even up to 30%, even more than 30%, I would make money on these puts. And so if that were to happen, I would sell these puts, then I'd have that money to just redeploy into the market, into the crash. The maximum amount that you can win on one of these puts, or that you can gain on one of these puts, is about $60,000. But of course, that would only happen if the market crashed all the way to zero. Or if the S&P 500 crashed to zero, then I would make like $60,000, which I doubt that would ever happen. That's certainly not going to happen. A 10% correction, sure, that's possible. 20%, yeah, that's possible, definitely. 30%, 40%, 50%, yes, possible. And so, as you guys can see here, if the market crashed, the lower the market goes, the more valuable these puts become. The higher the market goes, the less valuable these puts become. And so I just kind of, overdid it a bit by buying 6 puts that should be expiring next month. And so I guesstimate that, guesstimate that if there were a 30% crash sometime in between here and the next month, every one of these puts would be about a $10,000 gain. So that would be about $60,000, offsetting any losses from a crash. Of course, I don't want it to happen. I'm not looking forward to it. I don't want it to happen. But if it does happen, this is really the only way that I can see that I would be prepared in case it were to happen. Now, another thing that you can do, or that I noticed, is that I was talking about this ETF, SPLV. It's right here in my lineup here. Let me show you guys. I talked about it yesterday, SPLV. And so as you guys can see here, SPLV didn't really crash at all. Or when my portfolio overall was heading down, this was basically just moving sideways because it's low volatility. And as I mentioned before, I believe in my previous video, I would like to buy more of this ETF because this ETF has low volatility. It's based on the S&P 500. And this won't crash as hard if the market does happen to crash. This should bring some stability to my portfolio. Of course, none of this is financial advice. All of this is for entertainment purposes only. And so I will be buying more SPLV. Another, I guess, option that is available is to buy inverse ETFs, which I have 2 of them here. One on the S&P 500 and this one on the NASDAQ. And so as you guys can see, when this morning, this was kind of just going sideways, but this peak right here, when my portfolio went down, as you guys can see over here, it's a dip. In the inverse, it's a peak. And so I've been buying inverse ETFs just a little bit. I buy at least maybe once a month, one of each, especially when the market is really pumping. I buy at least one of each in case the market does drop. Because if the market drops, then those inverse ETFs will skyrocket. They'll pump. Plus, they're 3x leveraged, so they'll actually go up 3 times, which is another way to kind of potentially protect your portfolio from a major crash. And so, as you guys saw, that's a simulated return on options. You can kind of see how much it would make if the market were to have a drawdown. Of course, I'm hoping that it doesn't have a drawdown because I really don't want it to have a drawdown. But so, finally, we've got through the day. we've got through this rate cut. At first, it was kind of difficult to get through it because it didn't look very good. But now it's starting to look like maybe things are going to go back to going up. So, we got through it finally. It's over. It's done. We passed it, and now we're going to move forward. And I think that they announced that they're potentially going to do 2 more cuts this year. So when they cut, they lower the borrowing rates. So I'm borrowing money here from Robinhood. I'm using some amount of margin. And I'm assuming that with these cuts, the interest rate on this margin that I'm using here on Robinhood should be lowered. So it should actually cost me less money to borrow money from Robinhood, which will be very beneficial, not only for me, but of course for everyone else who is using margin or borrowing money. And so thank you guys for watching. I really do appreciate it. Please like my video. If you haven't subscribed, please become a subscriber. Hit the notification bell so that you're notified of my next upcoming video. Thank you so much. You guys have a great one. God bless. We'll catch you in the next video. Bye.